Hey, what's going on, guys? Welcome back. So this video is going to be more like a podcast type of format because there's so much information I need to go over in the stock market over the past couple of weeks, and there's just so much uncertainty going on in the stock market right now. There's just a lot to unload, and rather than, giving a really quick, one over of everything that's going on and just kind of saying like, oh, it all sums up to this, I'm going to be going through all of the major, say indicators and, metrics that have been coming out that have sent investors through a tizzy. You can look at the market over the past couple of weeks. The market has been experiencing significant amounts of volatility. And like, if you just take a quick look at the graph from year to date, once we started this year, it was essentially the market was recovering from last December. And then once all these things started happening, the market would fluctuate up or down 10% depending on the news. And so there's a lot to unpack and a lot to really get your head around to really understand like what the heck is the market doing. And as an investor, as someone that has this type of investment philosophy or this type of retirement goal or this type of financial goal, what should I really be paying attention to? So I'm going to try to unload all of that in this video. I actually spent about 4 hours today writing down all my thoughts about everything that's going on here. I guess that's the one good thing about having a 2-hour commute both ways to work. So hopefully you guys get some use out of this. I'm going to be talking about, the big buzzword recession. And I'm going to be giving my 2 cents on, after I kind of unpack everything that's been in the news recently, I'm going to unpack my decision on, how am I positioning myself accordingly? What do I think about, in the grand scheme of things, do I think that these numbers are that important to the stock market? Should it impact my trading philosophy? And just kind of prepping how I'm going to be ready for whatever type of environment we may or may not be going into, because obviously your guess is as good as mine at the end of the day. But I did want to take a quick poll, though. So those of you that do comment and that are pretty active in my comment section down below, I would like to know, before you get my opinion on what's going on in the market, I would like you to throw down in the comment section down below, do you believe we are headed for a recession, say within a year or two? And my main reason for that is that if you read the book, like in Irrational Exuberance or anything like that, that the market participants can pre-price in a recession. And if the majority of people believe that there's going to be a recession, it can become a self-reinforcing cycle. So I really kind of want to test the waters and understand, from other retail investors, really, where do you see the market going? And what is the biggest red flag you see? Or what is the most bullish thing you see that you think isn't fully priced in yet and it's going to push the market higher? So I'd love to hear your thoughts in the comment section down below, just to get an overall consensus and let this community really understand where everybody else is, staying at in terms of their opinion on the stock market. But getting away from all of that, just kind of giving a quick recap as to what's been going on in the stock market recently over the past couple of weeks. So this year has been pretty wild in the fact that the Federal Reserve has actually been cutting rates. Now, these rate cuts, as we all know, were brought on the fact that there were a lot of trade talks and that were not going that well. There was slowing global growth. There was slowing, metrics, whether it be from what the jobs report was saying and what people were expecting, what manufacturing was outputting. A lot of businesses, a lot of consumers are talking about how the tariffs are actually starting to have an impact on them. And the Federal Reserve just did not believe that the United States was in a strong enough position where they could keep hiking rates as they were. So they started to drop them for the first time since the last financial crisis. And now, I'm no chart wizard, and I'm sure, none of you are going to accept that I am, but if you just take a quick look at this graph, what is the very common trend right now? So this is going back all the way to 98. And just looking at the past 2 recessions. And it seems to be that anytime there was a major hike in interest rates and then it started to kind of level off and then pull back down, we very quickly ran into a recession within the next year. So that's just something that's kind of interesting. Obviously, you cannot use a chart, especially as, naive as this one, to really forecast anything concretely, but I did think it was interesting, and I definitely don't think it gives me the warm fuzzies, and I definitely don't think it gives most investors the warm fuzzies, just to kind of notice that the majority of the time that we have a quick rate decrease is essentially leading into a recession. And when everybody was already talking about uncertainties prior to the rate decreases, I am assuming most investors are very pessimistic as to what the Federal Reserve is doing. But then let's take a quick look at what happened today. So the jobs report came out today, and depending on what news outlet you look at, this is either a very bullish or a very bearish type of situation. So doing a quick recap as to what happened It's that you can see that the unemployment rate, the U6 in particular, fell to a 50-year low, is what I was talking about. So I believe it's at a 3.5 now. Yep, so it dropped from a 3.7 to a 3.5, and it came in with, adding in another 136,000 jobs into the market. However, the overall market was assuming that we were going to have 145,000. So some investors thought that, okay, that these numbers were kind of botched and they weren't really great. But at the same time, with the way I look at it, we're already at full employment, realistically. Like, we're supposed to be around a 5% unemployment rate, and we have been below that for a good while. So the fact that we are still growing jobs, I think, is just something that nothing to sneeze at right now, because it's extremely difficult to add as many jobs as we've been adding when the unemployment rate is already so freaking low. So I essentially viewed this as a wash. I'm definitely keeping my eye on how the unemployment rate is going. But in my opinion, the unemployment rate is already too low, so I'm not going to really be freaking out by any means until it starts to revert and we start losing jobs, the unemployment rate starts going up. As long as we essentially stay within a couple of basis points one way or the other, I don't really care what happens with the U6. There's plenty of a flaw with the U6 and the jobs report that gets published anyways. But for my overall takeaway, just due to the fact that the U6 doesn't include, people that are working part-time, it doesn't include people that are, on disabilities, it doesn't include people that are discriminated against in the workforce, being as that they've been out of a job for over a year and a half or 2 years, and they just stopped looking for a job. The U6 is just neglects so many people in the United States that do not have a job. I personally do not like using it as a benchmark. But thankfully, the market was kind of mixed on it, so there was some volatility right when it came out, but the market overall agreed that it wasn't that bad, and it started to trend higher throughout the day. And then, taking a look at it again, as you can also notice that of those jobs that were added in and taking a look at, wages over the past year, wages rose over the year about 2.9%. Now, when you look at that compared to the wage growth that we've had over the past, say, decade, that was realistically flat, that's at least... It's lower than it had been in recent months, but it's at least getting up there until you take a look at the inflation rate. So if you look at the inflation rate over the past year, it's ranged anywhere from, 2.8% to roughly 1.5%. And so it's been currently right now it's sitting around 1.8%. So realistically, in terms of real money and real buying power, wages have only actually gone up by 1%. And then when you take a look at the Federal Reserve, with the last time that they dropped rates, and they said that they were really worried about consumer spending, it seemed that for right now, consumer spending was holding up fairly well, better than they anticipated, and it was more business and manufacturing spending that was dropping quicker than they believed. To me, this is kind of this is a leading indicator of something could horribly go wrong very quickly if this wage increase starts to drop below our current inflation rate, and it continues to go down the negative path it's going. You're very quickly going to run into the fact that you have consumers that are loaded with debt. The majority of Americans have, between $30,000 and $60,000 in debt, not including their mortgage. And if their wages aren't growing at the rate that inflation's going at, everything's going to become a lot more expensive. They're not going to be able to buy things that they can and also service the debt that they have. So there can be a major contraction in terms of consumer spending. And if that happens, the consumer is roughly 70% of the United States stock market, or just the United States economy, excuse me. And the second that they start to feel the pressure, everybody's going to feel the pressure. And I definitely believe that both President Trump and Jay Powell do not want to, they're going to try to avoid putting direct pressure on the end consumer as much as possible. But right now, when you're looking at it, we have tariffs that are putting pressure on the consumer. And then we have a massive amount of debt, and the inflation rate realistically isn't that high in the grand scheme of things. So the consumer, on one hand, due to the tariffs, is spending more and more money on their products. And then the other hand, because inflation is still below historical means, their debt burden isn't getting relieved at a quick enough rate in terms of their job growth. So the U.S. consumer really is in a pickle. It's just going to be really interesting to see what side is going to be able to alleviate some of that pressure on the end consumer prior to a recession, if we're able to get there. Because if we hit a recession and the pressure is already put on the consumer and then they start losing jobs, it's going to be a self-reinforcing cycle to the negative, to the downward side. And it's something that is going to be a significant harder obstacle for both the White House and for the Federal Reserve to overcome to stimulate the economy again when you had them at brink capacity in terms of just getting by and barely growing, and then a massive amount of employees just lost their job. It will be extremely difficult and painful to get over that type of economic situation. And that's going to lead me to the next big buzzword that was going around in the markets recently, and that was the repo market. And now, for those of you that, don't have a finance degree or didn't go to school or didn't take economics and things like that, the repo market, in a very, very, broad and layman's terms way of doing things, is essentially the liquidity that banks have between one another. So this is the main reason why you have the federal funds rate. So the federal funds rate is at what rate banks are going to, try to charge one another for exchanging money. So like if you go to the bank and you try to take out a loan, and the bank physically in cash only has about half your loan. So if you try to take out $1 million and the bank only has $500,000 in cash, that bank wants to make that deal that day. So what that bank does is they essentially give an IOU to another bank, whether it's in the form of treasuries or in some very extremely safe security, for a particular interest rate. They give it to their neighboring bank, and that bank will then transfer them the cash through a wire, and then they're able to fill that loan to the consumer. And then by, say, generally the next day, the banks reposition their cash and they pay it off. But the interesting that happened was that randomly there was an incredible spike in the repo market. So as you can see, for a while now, for the majority of September, it was kind of coasting around realistically within 0.5% or so of where the federal funds rate was, which is like normal. The Federal Reserve asks that banks try to regulate their lending within that range to one another, and then out of nowhere there was a massive spike. And now what caused this spike was the fact that liquidity totally drew up. And so what that means is if Bank A is attempting to, borrow money with an IOU from another bank to service a customer's loan, and they go to the first bank, and that first bank doesn't have that liquidity, and then they go on to the next bank, and then the next bank, and the next bank, and none of those banks at the point in time have the liquidity to kind of give them that. Eventually, even though it's not supposed to happen, what ends up happening is that wire gets bounced around so much, and that ask for that type of a loan is just kind of going around. All the other banks can see this. So then the banks that do have the liquidity are kind of able to look at it and understand that, okay, I can make you pay as much as I want because you don't have any other option. So in a very, very short amount of time, so in less than 48 hours, the rate that banks were, paying one another went from a 2.3% to a 10%, which is really, it's just completely outstanding. And if any of you listen to the Investors Podcast, and if you don't, I highly recommend listening to it. It's a very useful resource for retail investors. They kind of looked at, they pulled up a report, and it looked at the statistics of what type of move was this, and it was something like a 64 standard deviations out of the norm. Which, if any of you have taken a statistics class, within 1 to 2 standard deviations is like the 99 percentile of events happening, or I'm sorry, 99.5% of something happening. So when you hit that far out, it is such a minute amount that no algorithm, no economist, no one saw this coming, and it shocked a lot of people. And the only way to relieve that and to pump liquidity back into it, the Federal Reserve had to pump almost $300 billion in the span of a week into the repo market just to make banks being able to start lending money to one another. And this is the first time that they were talking about it since 2008, since the financial crisis, when so many banks were defaulting and they weren't really able to get liquidity anywhere. And the Federal Reserve just kind of threw this out there randomly, and no one saw it coming. No one expected it to come out, and no one really knows what to do from here. The initial headline was like, okay, the Federal Reserve was able to mitigate the issue. Yay, cool. But then people started to think about it, and they realized, wait a second, that still shows that we have a major liquidity issue between all of our banks. And with debt at an all-time high and with the overall economic growth slowing down, you really do not want to have a liquidity issue with your banks. So that spiked a lot of fear into the stock market, and that's why those of you that haven't taken economic classes have now learned what a repo is, something that generally you don't really need to pay attention to unless, one, you're investing in the bank sector, or two, you're looking at overall macro trends, or you're just passing a test at the end of the day. And now, so I want to get into the second part and second point I wanted to make in this video. So that was just kind of unloading all of the shenanigans that's going on in the stock market right now, in the global economy, and why there's so much volatility in the stock market. And so now I'm going to kind of explain how that relates to me and how I am anticipating needing to manage and tweak my portfolio in order to deal with it, and like what things I'm thinking about selling and what things I'm thinking about buying. So I want to start this off though with the fact that I am not attempting to time the market. And it is something that, regardless of how bad things seem, I need to remind myself to have strength and to not give in to fear or greed and say that, okay, I'm just going to go all in cash right now because things are looking bad. Because things look bad all the time in the stock market. If you take any, like, say, 3-quarter period length of time, generally there's going to be at least 1 month that people are, like, freaking out about a recession. And, 9 out of 10 times everybody freaks out, they sell out. And they realize that the next month everything's hunky-dory again, and they have to rebuy their stuff at a higher level, and they just missed out on all that money and then had to take a tax hit. So I'm attempting to not seem like I'm attempting to time the market. I definitely am not trying to get that across, but I am just kind of reaffirming what trades I've been doing, what restructuring I've been doing with my portfolio over the past year now, ever since this channel portfolio started, how my investment philosophy has changed. And thankfully, I started to make that change right before all of this went down. So thankfully, I was cushioned a lot to it. So you can see right here that my portfolio, I went for a more conservative route, and I went to, kind of alleviate a lot of my risk in comparison to the overall stock market. And so now, like, I'm still up almost 10%, and the stock market is up 2.26%. So in terms of just the S&P 500, I have performed very well because I made the proper turn to switch my portfolio to a more conservative portfolio once I started to see warning signs, of slowing growth. The growth index is right behind me, but again, the amount of volatility that is in the growth index for someone that is just a growth investor compared to my current portfolio is, they might have a beta of like 1.5, whereas I have a beta that's under 1. And for those of you that don't know, a beta is essentially just the really quick way that people measure risk. It's pretty flawed, but the really quick way that people measure risk using beta is just the volatility that the stock price has in retrospect to the index. The index has a volatility of 1. So if your company, a company like Starbucks that doesn't move, it's not as volatile as the stock market, sits with a beta around a 0.5, whereas a company like AMD that shoots all over the place depending on the day and depending on what comes out has a beta of 3, meaning it's 3 times more volatile than the stock market. So that's kind of the way I'm looking at this. I'm not looking for absolute return right now. I'm looking for cash flow and capital conservation while mitigating my risk. So that's kind of been the whole point of this. And so as of right now, looking at my portfolio and looking at all those things that I've had and percolating on the fact that okay, there's a lot of negative things that are coming out, and they came out very quickly. And when I look at it, though, it's it's very negative, and it seems like it's bad, but I don't think it's a clear trend. Yeah, I think that right now, this is something that could very well, go away within a quarter. Just due to the fact that there are so many variables that are going on right now that could very easily, depending on how Trump and President Xi get along with one another, could very easily go away and re-stimulate growth. I'm not too worried right now in the fact that we're gonna have a recession within the next 6 months or anything like that. I personally don't even see a recession within the next year. And again, obviously attempting to see a recession before it happens is a fool's game. But personally, I'm not too worried right now for a recession. Say 2 to 3 years out, maybe I would say that that's probably closer to a right now. If the numbers continue to go the way that they're going, I wouldn't be surprised if it was say a 75% chance of having a recession. And that's a very, a rounded number based off of just kind of the last times that we saw these trends. China went through a recession, and since the US is starting to see trends like this, I could see the US going through recession. And, if that continues, I think it's just going to be a self-reinforcing cycle, because if the US goes down, pretty much everybody else will go down, and Europe is already kind of on their last leg. So I wouldn't be shocked if we had a recession, say, in the short term, which meant say sub 5 years. But I definitely don't see it happening within the next few months. So right now, I'm kind of looking at where is the most optimal way to position my money so that way I'm still in the stock market, but I'm exposed to the least amount of risk when the risk is on the up and up. And so the sectors I'm currently looking at, and in terms of value, in terms of like where I can deploy my capital, are going to be the industries like fast food, consumer staples, defensive industries, and certain manufacturing. So that's going to be like a Honeywell, or that's going to be like a Raytheon, or you have a consumer cyclical. And that is mainly because it sounds kind of contradictory to be looking for value in a consumer cyclical nature. And that's because, based off what the Federal Reserve said the last time they dropped rates, is that the consumer in America is still spending a lot of money. And so if the consumer continues to spend a lot of money, I think that they're going to get another, like, a second wind in terms of revenue growth. And when everything else is, losing value, a company like a Starbucks might actually be going up in the short term, just because consumers, like, when hard times come, they're going to hit businesses first before consumers. So I think that, a business isn't going to be buying, like, say, a brand new suite of supercomputers, but, Sally that works, and makes $60,000 a year, she's still probably going to go to Starbucks every day. So I'm kind of looking for, sweet spots of value in that type of regard. Now, in terms of the overall portfolio, and so here, just to like kind of look at my my weightings of everything, I want to decrease my risk to, I want to say, business expenditures. And what I mean by that is I'm looking at companies that get their revenue particularly from enterprises and not from consumers. And so you can think about that as a company like a Facebook, like a company like an Intel, a company like a Nvidia. Things that are, the majority of their money comes from enterprise purchases. Because if there's an overall slowdown in the economy, enterprises have a CFO that their job is to, like, mitigate risk, preserve capital. They have a treasury that is designed to, not lose money, something that the average consumer does not have. So I think that those people are going to, really tighten up their wallets before, like, say again, like Sally does. So I would see, like, if things start to go south, those are the types of companies I see getting hit quick, getting hit really hard, and without a lot of notice. So I figured, like, I'm already up. So, like, for example, like with Facebook, my Facebook positions, the lots that I bought are up quite a good amount. So this one's up 21%. This lot is up 45%. And, Facebook right now is at about 15% of my portfolio. So I can bring that back to, like, say, a 10%, just to free up some cash, because I'm only sitting on 15% cash right now. And I'd feel a lot safer. Nvidia is 5% of my portfolio. And Nvidia, I bought that at a pretty good time. It's essentially like another trade again, because you know me and semiconductors. But, I'm up 21% with that, and that's just in a couple of months. So I can sell that and be fine with it. Intel is kind of interesting. Intel, I'm up a similar amount as I am with Nvidia. However, I personally think Intel, out of those three companies, can weather the storm better, just due to the fact that they've already weathered so many recessions. Their balance sheet is pretty strong. Their free cash flow, I think, is going to be the least volatile out of all three of those. So Intel would probably be the last one I cut, just because Intel's already trading at such a low valuation. And so many people are already pricing in a significant, hit to Intel's revenue, let alone the other two. So that's just kind of a side thing. Things that I'm also thinking about increasing my exposure to are, say, a Starbucks, if it continues to go in that downward trend and it gets pulled down with the rest of the market. A Domino's, if Domino's starts to go on sale right now, Domino's is about fair value. So I got in, scalped like about 7% realistically, but Domino's right now isn't like trading for a bargain. So I just wanted to get some money in there to deploy some capital. But if it jumps off a cliff, that's what I'll be looking for. So if these types of companies get pulled down with the overall market, just because of overall pessimism is brought back in, consumer staples, or, anything that's like a consumable for the end consumer, that's like a food product that people are going to try to cut out last. They're going to cut out their phone first. They're going to cut out, needless trips and things like that. But they're going to cut out fast food and, like, going out to eat probably last, in my opinion, just based off of, the industries I've worked in and, growing up with college kids that are poor. Going out and buying fast food seems to be like the last straw for what people are willing to stop spending money on, even if they don't have money. So I'm pretty bullish on those companies, one, for the long term, but also if they get pulled down, I think they're going to get pulled down in a disproportionate route, and I think that that's where I can deploy money. Another company that I'm thinking about selling out of is Google, mainly because Google I bought and it quickly ran up, and Google's kind of in the same business model essentially as Facebook. And if I trim part of my Facebook, I might need to also trim part of my Google, because that way I'm really actually getting rid of that risk that I have there. But granted, I'm up a significant more in Facebook, and I might just sell out of that. But that's another thing. I just want to keep you guys in the loop with like what's going on in my mind, what types of companies I want to get out of, or thinking about trimming some. I don't know if I'm going to sell out of Facebook, but I'm definitely probably going to trim some of my Facebook stock. And so those are the kind of things that I'm going for, because the overall plan I want to have right now is I want to make my beta in my portfolio, below a 0.8. And I also want to have the yield on my portfolio, so like the dividends that I'm receiving, that cash flow, I want to get that between a 2.5% and a 3.5%. And I'm not trying to go high yield right now. I'm not trying to get a 4 to a 6% on my overall portfolio, because I'm still not too worried about the economic times. And I think right now I can still have some dividend growth. I can still have some growing companies, because if everything, is, pushing up daisies in just a couple of months, companies like Facebook, Starbucks, Monster, all those companies are going to start to drastically outperform again. So I'm not going to be dumping all my money in a company like Altria or AbbVie anytime soon. But that's just kind of the overall focus I'm going in with my portfolio. And so that's going to wrap this up. This was, I know, a very long video, and it was just kind of almost like a podcast type of approach to it. But there was just so much information I wanted to unpack, give you guys exactly, what's going on in my head. I know a lot of you and I go back and forth in comments down the comment section down below for like hours at a time, depending on the topic. And this is just kind of that way everybody can get their questions answered. Still, make sure to drop some comments in the comment section down below. I think I might be doing this length of a video maybe every Friday, just as kind of a chill way to recap the week or recap what's going on. And then also I'll be answering questions that you guys have throughout the week, so that way, if I'm busy and I can't really get to your questions or have a back and forth with you, I can like fully explain my thoughts, rather than sending you a text message on the video. And I think I might be doing that. So let me know if you guys are interested in that in the comment section down below. And as always, guys, if you've stuck around to the end of the video, make sure to hit that like button. It helps me out a lot. The algorithm of YouTube, the almighty algorithm, it'll help me out a lot. And then make sure to hit the subscribe button, because again, if you just sat with me for about 30 minutes, you obviously gotta like something, whether you just like making fun of me or you actually like the content I'm putting out. You gotta have some reason why I stick around to the end. So make sure to hit that subscribe button and that bell notification. But that's gonna be it for this video, guys. Hope you guys got some use out of this, and I will catch you guys in the next one. Peace.